Hi, and welcome to this market and economic update. In today's video, we'll take a look at the recent jobs report and the impact that it's having on markets and interest rates. This past month has seen significant market volatility, including a market correction at the back half of October. However, since then, markets have rebounded quite significantly on the back of increased optimism that the economy can achieve a soft landing. Let's take a look at why this is the case. First, market volatility across stocks and bonds has been elevated for quite some time. Volatility is simply the idea that prices can swing on a day-to-day or week-to-week basis. For investors, oftentimes this volatility can be unnerving. While investors often focus on stock market volatility, this chart highlights the volatility in the bond market. We can see that the market has been especially uncertain over the past 2 years due to interest rates and inflation. What's helped over the past couple of weeks is that new data shows that the economy is more balanced than previously expected and that the Fed might be done with its rate hiking cycle. This has allowed interest rates to stabilize and has even spurred a stock market rebound. So why is this happening? The latest October jobs report showed that hiring decelerated a bit. While this would normally be considered bad news, investors have been hoping for signs of a slowdown as the Fed battles inflation. Put another way, investors have been looking for a Goldilocks economy that's neither too hot nor too cold, one in which inflation improves and the economy is healthy, but not too healthy. The latest report from the Bureau of Labor Statistics showed exactly this. Specifically, 150,000 jobs were added in October, which were fewer than expected. This was partly due to factors such as strikes in the manufacturing sector, but unemployment also ticked up to 3.9%, and labor force participation fell slightly. These dynamics have allowed interest rates to come back down a bit. The 10-year Treasury, which had hit 5% just a few weeks ago, is now back around 4.6%. Market-based expectations of policy rates suggest that the Fed might not raise again this cycle, as shown in this chart. While this is still uncertain, it does show how quickly market expectations can change based on the data, especially in periods of high volatility. The main takeaway here is that investors should not get caught up in every headline or focus too much on the ticker tape. Market circumstances can change quickly as new data is released, resulting in market swings. Instead, investors should always focus, like we talk about, on long-term trends, which in this case is the fact that the economy is healthy and inflation is improving. At the same time, investors should always be prepared for periods of volatility, which, while unpleasant, always pass. Well, certainly the data is coming in hot and heavy. Is the Fed done with its rate hiking campaign? We certainly think so. I believe the market has shown that it believes so, as well as the 10-year Treasury just last week came off of its 5% peak all the way down to 4.6, a little below 4.6%, which is a welcome sign for bond investors. And we've seen a little bit of forward momentum in the equity markets as well. So some recovery happening as we head into the end of 2023. And now our sights are certainly set on 2024 and the potential opportunities that exist in not only the equity market, but also the fixed income market. And so I hope this video was insightful and helpful. And if you have any further questions, please don't hesitate to reach out. I'm always available and look forward to speaking with you all real soon. Take care.